If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Sweden's economy shows signs of a slowdown. Q2 highlights: GDP growth near zero, unemployment rising, rates still high. This is Economics FX with a data-driven breakdown. Here's what Q2 tells investors. Sweden's economy in Q2 reflected a clear slowdown. Headline indicators showed weaker output growth. Household consumption stayed weak. Construction remained under pressure. External demand provided only modest relief. The pattern reflected a technical recession followed by a hesitant recovery. Structural fragilities in housing, investment, and retail persisted. The labor market softened as unemployment climbed. Youth unemployment remained high. Regional disparities persisted between metropolitan and rural areas. Interest rates remained restrictive despite falling inflation. The Riksbank's key rate stood at 4.00%. Mortgage costs rose, pressuring household income. Consumer price inflation fell, showing visible improvement. Core inflation also eased, but services pressures lingered. Public finances saw debt to GDP edge slightly higher. Government avoided large discretionary stimulus. The slowdown highlighted limits to fiscal response. Household consumption remained a weak link. Housing investment continued to contract. Exports offset some weakness. Pharma, automotive, technology. A weaker krona helped competitiveness but was not a cure. Outlook into H2 suggested stagnation without policy shift. Inflation at 2.4% left room for cautious easing, but the Riksbank signaled no rush to ease. According to Trading Economics, Sweden's GDP annual growth rate in Q2 2024 contracted by 0.1% year-on-year, following a 0.7% decline in the first quarter. Output dynamics remained fragile as household consumption stayed weak. Construction remained under pressure. External demand offered only modest relief. By Q1 2025, GDP returned slightly positive at 0.3% year-on-year. The rebound was modest. The economy continued to be described as stagnating. This represented a broader pattern, a technical recession in late 2023. Structural fragilities in housing and investment weighed on momentum. The labor market softened in line with the slowdown. Sweden's unemployment rate climbed to 8.1% in June 2025, up from 7.9% in May, and higher than the 7.5% average in late 2024. Rising joblessness reflected lagged effects of tight monetary conditions. Slower construction activity and weak consumer-facing services contributed. Youth unemployment remained particularly elevated. Metropolitan areas adjusted better than industrial or rural regions. Labor force participation rates stayed high, matching structural tendencies. Interest rate policy remained restrictive despite falling inflation. The Riksbank's key policy rate stood at 4.00% in July 2025, unchanged since mid-2024, after successive hikes from near zero. This is the highest benchmark since before the global financial crisis. The policy was aimed at containing inflation expectations and stabilizing the krona. Tight monetary policy created strains for households with variable mortgages. Debt servicing costs surged, depressing disposable income. Consumption suffered as a result, contributing to the slowdown. Inflation declined to 2.4% in July 2025, down from 3.7% in April, and well below 2022 peaks above 10%. Core inflation eased, indicating broader disinflation. The fall was driven by lower energy costs and normalized supply chains, but services inflation and wage pressures continued to linger. The Riksbank remained cautious. Easing was not rushed. Public finances revealed another dimension of the slowdown. Government debt to GDP rose slightly to 35.3% in 2024, up from 34.6% in 2023. Modest deficits linked to energy subsidies and support measures contributed. By mid-2025, debt levels hovered around 36% of GDP. The government avoided large discretionary stimulus to preserve fiscal space. Political caution constrained aggressive fiscal action. The combination highlighted the essence of slowdown in Q2. GDP growth at or near zero reflected weak demand and subdued investment. Unemployment rising above 8% highlighted labor market deterioration. Interest rates held at 4.00% imposed ongoing strain. Inflation fell into the 2-3% zone, but policy remained cautious. Housing investment continued to contract. Exports provided some offset, particularly in pharmaceuticals and automotive components. Technology exports helped, but slow European demand limited relief. A weaker krona provided competitiveness gains, but external demand could not offset domestic softness. The outlook into H2 2025 suggested stagnation would persist unless policy shifted. Inflation at 2.4% gave room for cautious rate cuts later, but the Riksbank signaled it would not rush to ease. Unemployment was expected to remain elevated, fiscal space existed but was politically constrained, policy reliance fell more on monetary tools than fiscal action, debt to GDP around the mid-30s ensured solvency but limited bold stimulus. Household consumption suffered after years of inflation and higher mortgage costs. New construction was delayed as financing costs remained high. Exports helped, but European demand was sluggish. The combination painted an economy stuck between stabilization and stagnation. Until confidence improves and rates ease, Q2 remains best described as slowing. Case Study 1. Housing Sector Adjustment Sweden 2025. Housing investment contracted as financing costs rose. Variable rates hit household balance sheets hard. Disposable income fell, weakening discretionary spending. New projects were delayed, slowing employment in construction. Prices adjusted downward as demand softened. Developers faced stricter credit standards. The sector remained a drag on near-term growth. Regional effects showed stronger impact outside metros. Secondary effects hit retail and local services. In short, housing weakness slowed job creation and spending. Case Study 2. Labor markets and rising unemployment. Unemployment rose to 8.1%, pressuring consumption. Youth unemployment remained elevated, especially in rural areas. Slower industrial activity translated into furloughs and hiring freeze. Participation remained high, but job creation lagged. Policy efforts focused on reskilling and regional support. Metropolitan labor markets showed more resilience. Services sectors that depend on consumption felt the squeeze. Wage dynamics added uncertainty for policymakers. Regional policy coordination was identified as a priority. Near-term outlook pointed to elevated joblessness if growth stayed soft. In sum, labor market weakness amplified the slowdown. Case Study 3. Monetary policy, debt and households. Rate hikes brought policy from near zero to multi-decade highs. The 4.00% benchmark created higher debt service costs. Disposable income was compressed, reducing consumption. High household debt made policy trade-offs more complicated. Policy firmly targeted inflation control to preserve price stability. Debt to GDP around mid-30s kept fiscal options limited. Households cut discretionary spending, hurting retail. Developers faced high finance costs, delaying new supply. Export gains were helpful but insufficient to reverse domestic softness. Krona weakness helped on pricing but not enough. The case studies underscored how housing, labor and rates interacted. Analysis. Putting the metrics together. GDP near zero, unemployment above 8%, rates at 4%. Tight rates transmit through debt service into lower consumption. Weak consumption feeds back into services and retail. High financing costs reduce housing and business investment. Exports provide some support but are limited by European demand. Policymakers face a trade-off between stability and growth. Falling inflation suggests room for easing but risks remain. Fiscal policy was limited by political and rule constraints. Scenarios: base case stagnation, downside if demand remains weak. Investors should watch rates, unemployment, and consumption indicators. Leading indicators like consumer confidence will signal turns. Companies with high leverage face greater risk in weak demand. Fixed income markets may reprice if easing is signaled. Watch services inflation and wage dynamics for policy signals. Regional differences mean targeted measures could be more effective. Export-oriented firms may perform better than domestic-focused businesses. Fiscal room exists but political will matters for any stimulus. For investors, risk management and diversification are key. Key watch list: rates, inflation trends, unemployment, housing data. Unless rates ease, stagnation is more likely than acceleration. Summing up, Q2 shows a stalled recovery with policy dilemmas for the Riksbank. In summary, Sweden's Q2 performance points to slowing growth, rising unemployment and high rates. GDP near zero, unemployment around 8.1%, rates at 4%, inflation 2.4%, debt approximately 35%. For investors, monitor policy signals and sectoral resilience. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.